Okay, let's kick things off. Wow. Still catching my breath a bit. I had to practically run from the park. Gorgeous day out there. But clearly the Taiwan stock market had, well, other ideas today.
Yeah, quite the jolt. A drop over 2,000 points is significant.
Significant is putting it mildly.
Yeah.
And nearly 1,000 stocks hitting limit down. That's a record, right? I mean, for anyone maybe not following super closely, limit down means the price just tanked by the maximum allowed for one day. It was something else watching the screens.
It really was. And that kind of volatility, well, that definitely demands a closer look, doesn't it, to try and understand what's driving it and, what it might mean going forward.
Exactly. And that's what we're here for today. This is our deep dive in all this market chaos, but we're really going to zero in on TSMC, Taiwan Semiconductor Manufacturing Company.
Makes sense. Given how crucial they are globally, what happens with TSMC, well, it tends to ripple outwards, far beyond just Taiwan.
Absolutely. So, to figure this out, we're looking at a few things. There's a recent YouTube discussion with a market expert we found insightful, plus, of course, TSMC's own latest financial report, and some historical context.
Right. The goal here isn't just to report the news, but to sort of pull out the key insights, wouldn't you say?
Yeah, exactly. To cut through the noise, help everyone listening understand what's actually going on with TSMC and the wider market without getting lost in, all the jargon.
So providing some clarity, maybe some actionable takeaways, by looking past the sort of immediate shock and finding the real signals.
Perfect. So let's start with that YouTube discussion.
Yeah.
The experts' immediate reaction to the drop. What was their take?
Well, their gut feeling right after that big drop was that it probably wasn't just a one-day thing. They suspected we might see more downward pressure in the next few days.
Okay, so caution was the word.
Definitely. And they brought up margin trading specifically.
Uh,
Yeah, speculating that the pressure on those borrowed money positions could maybe even last until Friday. It highlights how, one big move can trigger other forced selling.
that domino effect. Okay, and this expert, they weren't just talking, were they? They actually put their money where their mouth was.
That's the really interesting part. They mentioned putting in close to NT $100 million personally on that day.
Wow, on the day of the massive drop. Why?
Their thinking was that further drops would actually be big buying opportunities.
Yeah.
So they were stepping in, anticipating potentially lower prices ahead as a chance to buy quality.
That takes some nerve and a lot of conviction.
It really does. It's that classic, almost Buffett-like approach, isn't it?
Yeah.
Seeing market panic as a chance to buy good companies cheaper.
Right, focusing on the long-term value instead of just like predicting the absolute bottom.
Exactly. It's different from, say, an economist who might correctly predict a downturn, but doesn't necessarily translate that into an investment strategy.
Yeah.
This expert was acting on their view.
And this view was likely shaped by some broader worries too, right? The YouTube discussion touched on bigger economic fears.
Oh, absolutely. They mentioned the sort of chatter out there, institutional forecasts, talking about a possible global recession, maybe even stagflation, slow growth plus inflation.
Ugh, not a great combo.
Not at all. Plus, all the uncertainty about interest rate cuts. When are they coming? Are they coming? It all feeds into the nervousness,
So lots of moving parts, economically speaking.
for sure. And the expert had an interesting take on the market bottom, the so-called falling knife.
Yeah. What did they say?
They suggested the actual low point might happen before all these underlying issues, like, say, trade negotiations linked to potential U.S. policy shifts, are fully sorted out.
Ah, the market looking ahead, pricing in recovery before it actually arrives.
Exactly. Markets tend to anticipate. But what really struck me was the experts' emphasis not just on forecasts, but on psychological strength.
How so?
Well, they stressed how important emotional resilience and good capital management are in times like these. Maybe even more important than trying to guess every economic twist and turn.
So it's about how you handle the storm, not just predicting the weather.
Precisely. Forecasts give you a map, maybe, but they aren't the journey itself. Staying disciplined, managing your money wisely, that's key to navigating volatility, according to this view. A calm strategy over just trying to be right.
Makes a lot of sense. Okay, shifting gears a bit. Politics came up too. Specifically, something about the Taiwan elections and a sedan chair analogy. What was that about?
Right, the sedan chair. The idea there, as the expert explained it, is that leading up to an election, you need a certain market stability. You can't have it crashing or soaring too wildly.
All right.
So the market needs to be carried, like a sedan chair, in a way that keeps both the bulls, the optimists, and the bears, the pessimists, somewhat satisfied. It implies a need for balance, preventing extreme moves that might upset one side or the other too much before the vote.
Huh. Interesting analogy, like threading a needle to keep everyone relatively calm. Did they compare this current situation to past downturns, like 2008 or the pandemic?
They did, yeah. They mentioned August last year, the 2022 dip linked to the pandemic and war, and the big one, 2008. But the key point was that this current situation doesn't quite match any of them perfectly.
How is it different in their view?
Well, 2008 was a systemic financial crisis. The pandemic was a unique global shock. Last August was smaller scale. This time, the expert linked it more directly to renewed concerns about global trade friction, especially potential U.S. policies under Trump.
Right, those trade tensions again.
Exactly. And interestingly, the expert suggested that while these policies might cause short-term pain for some countries, they could potentially strengthen the U.S. financial markets in the long run if they achieve their aims.
That's a big if, but a significant potential shift in the global dynamic.
It definitely is. It points towards a possible reshoring or rebalancing focus, benefiting the U.S. economy, but, not without global repercussions.
Okay, let's zoom back in on TSMC itself. The expert raised some specific potential headwinds, didn't they? Starting with tariffs.
Yes, the potential for the U.S. to impose I think it was a 32% tariff.
Hmm.
And while semiconductors aren't included now, the expert noted that's not necessarily permanent. That's a hanging uncertainty.
Yeah, for a company so globally connected, especially with the U.S., that's a risk you can't ignore.
Absolutely. It could definitely impact costs, competitiveness, the whole equation.
And what about those rumors about a possible joint venture with Intel? How do the experts see that?
They seemed, well, relatively relaxed about it. Their take was that TSMC kind of had to set up shop in the U.S. anyway, given their reliance on U.S. clients and, importantly, U.S. design software.
So a strategic necessity.
Pretty much. And they didn't seem too worried about the kind of technology transfer risks you might see in other situations, implying maybe a stronger level of trust or established safeguards in a U.S. context.
Okay. And there was that interesting tidbit about risk management within TSMC, something about the Enron scandal.
Oh, right. Yeah, the expert mentioned that TSMC's chairman, Mark Liu, apparently made a point of studying the Enron collapse.
As a what not to do guide.
Exactly.
Yeah.
As a way to learn lessons and build in safeguards to prevent similar corporate governance failures at TSMC. It suggests a real focus on, long-term stability and ethical management from the top.
That's definitely reassuring to hear. Okay, let's talk financial health. The expert brought up a former TSMC CFO.
Yes, who apparently advised investors to be greedy during this current dip, basically saying, see this as a buying opportunity.
Wow, that's a strong statement from an insider, even a former one.
It really is. It implies a deep belief in the company's fundamental strength, suggesting the market might be overreacting compared to the company's actual value.
Then there was that refrigerator theory. What was that aiming at?
Yeah, the refrigerator theory. It's sort of a quirky way to think about long-term gains. The idea was aiming for something like a 200% return from the current price.
Like tripling your money.
Essentially, yeah. But over a longer time frame, maybe looking out towards, say, 2030, not overnight. The analogy is like buying a reliable fridge. You expect it to perform well over many years. It implies a target price around NT $2,000, but with patience.
Patience being the key word. And they use some vivid phrases for the market dip too, right? Like oil dipped again or backing up to pick up people.
Yeah, those analogies really stick. Oil dipped again and pressed the zero twice, like getting a reset, a chance to buy lower. And backing up to pick up people. The market giving investors who missed the bus another chance to get on board at a better price.
It paints a picture of opportunity amidst the gloom. What about their actual cash situation? That sounded impressive.
Hugely impressive.
Yeah.
The expert pointed out that even after spending over $1 trillion NT dollars building new fabs between 2020 and 2024.
Which is an enormous investment.
Right. They still have something like NT $2 trillion in cash reserves. The expert called it silent wealth. It just sits there, providing immense financial flexibility.
Flexibility for what? More expansion, R&D, weathering storms.
All of the above. R&D, future investments, dividends, buybacks, navigating any downturns. It's a massive cushion and a sign of incredible financial strength. Plus, those investments show they're committed to staying ahead technologically.
Okay, so if someone is seeing this as an opportunity, how did the expert suggest approaching it? That smiling curve strategy.
Right, the smiling curve. It's basically a way to average into the stock as the price falls. Instead of trying to guess the exact bottom, you divide your investment money into chunks or tranches.
And buy incrementally.
Exactly. Maybe, say, put 20% in if it hits NT $800, another 30% if it drops to NT $750, and maybe the remaining 50% if it goes down to NT $700. Those are just illustrative numbers, of course.
So you buy more shares at the lower prices.
Yeah, the goal is to lower your average cost per share by buying progressively more as the price declines, making the curve of your average cost sort of smile as the price hopefully recovers later.
But what if it turns around before you've put all your money in? What if it starts going back up from, say, NT
Good
$780?
question. The expert's advice was essentially still chase it.
Chase it up, even if you miss the absolute low.
Yeah, because timing the exact bottom is almost impossible. If it starts recovering strongly, it's usually better to get in on the way up than to sit waiting for a potential lower dip that might never happen again.
Yeah,
Don't let perfect be the enemy of good, basically.
got it. And for people already holding TSMC, maybe at a higher price, and now seeing red, what was the advice?
Generally, the advice was to hold on. The expectation is that a company like TSMC will recover strongly over time.
So resist the urge to panic sell or switch into something else like an ETF or bonds right now?
That seemed to be the message, yeah. Based on the belief that TSMC's long-term potential is strong, maybe stronger than the broader market, so switching now might mean locking in losses and missing the eventual rebound.
Okay, that makes sense for TSMC specifically. The discussion also broadened out again to asset allocation and U.S. debt. That's a big macro topic.
It is. They mentioned the huge amount of U.S. debt maturing in 2025, something like $3 trillion was the figure used. And naturally, that raises questions about risks, potential default, restructuring.
Yeah, $3 trillion is a number that gets your attention. What was the expert's perspective on the actual risk?
They felt a full-on default was pretty unlikely. The damage to U.S. credibility internationally would just be too severe.
So what's more likely then?
Negotiation, extensions, finding ways to manage the maturities rather than an outright default. Kicking the can down the road, maybe, but avoiding a catastrophic failure.
And how does that feed back into investment strategy or asset allocation?
The takeaway was basically don't derail your long-term plan because of these big macro headlines. These things tend to get negotiated and muddled through. Stick to your appropriate asset allocation rather than trying to time the market based on potential debt ceiling drama or maturity cliffs.
Right, focus on what you can control, which is your own portfolio structure.
Exactly. Trying to outguess those high-level negotiations is a tough game. Better to stay diversified and focused on your long-term goals.
Okay. And then the conversation circled back to Trump's potential economic policies. 4 main goals were outlined.
Yeah, the experts summarize them as 1, reducing trade deficits, 2, lowering taxes, 3, bringing manufacturing back to the U.S. or reshoring, and 4, tackling the national debt.
Let's quickly unpack the why behind those, according to the expert. Reducing trade deficits.
The idea is to improve the balance of trade, maybe use tariffs as leverage to get better deals, and support domestic production.
Lowering taxes.
Standard goals stimulate the economy, offset potential price increases from tariffs, maybe leave more money for consumers and businesses.
Bringing manufacturing back.
That gained a lot of traction during the pandemic, right? Supply chain vulnerabilities became obvious. So the goal is more self-sufficiency, less reliance on other countries for critical goods.
And finally, tackling the debt.
Well, the sheer size of the U.S. debt and the interest payments are becoming a huge burden. The expert apparently drew a comparison, saying the interest alone is massive, maybe comparable to like the entire market value of Taiwan's stock market, just the interest. So getting that under control is seen as vital for long-term fiscal health.
Wow. That interest comparison really puts it in perspective. And the overall view was that these policies, if they work, could be long-term positives for the U.S. economy.
That was the suggestion, yes. A focus on strengthening the U.S. domestically, even if it causes friction elsewhere. Of course, the actual outcomes are complex and depend on implementation and global reactions.
Okay, let's switch from the experts' views and speculation to the hard numbers. TSMC's Q1 2025 report, how did they actually perform?
Very, very well, actually. The numbers were quite strong. Earnings per share, EPS, came in at NT $13.94. That's up over 60% compared to Q1 last year.
60%, that's huge growth.
It really is. Revenue was also up significantly, 41.6% year-on-year, hitting almost NT $840 billion. Net profit jumped 60% too, to over NT $360 billion. And margins look healthy.
What were the margins?
Gross margin was 58.8%, and operating profit margin was 48.5%. Very solid numbers.
And where's that revenue coming from? Which chip technologies are driving it?
Mostly the advanced stuff. The report showed that their leading-edge nodes, 3 nanometer, 5 nanometer, and 7 nanometer, combined made up 73% of their wafer revenue in Q1.
So the demand for the most powerful chips is clearly still very high.
Absolutely. That's where TSMC really dominates, and it's clearly paying off.
Okay, so that was Q1. What about their forecast for Q2 2025? What are they telling the market to expect?
Their guidance for Q2 is revenue between 28.4 and 29.2 billion US dollars. That's based on an exchange rate assumption of 32.5 NT dollars to the US dollar.
And margins, are they expecting those to hold up?
Pretty much. They guided for a gross margin between 57% and 59%, and operating margin between 47% and 49%. So broadly similar to Q1, very strong levels.
Did they mention any specific trends or risks affecting Q2?
Yeah, they noted the usual slight seasonal dip in smartphone demand in Q1, but said that was offset by really strong growth in AI-related demand. That seems to be a key driver now.
AI picking up the slack from phones.
It's like it. They also said they haven't seen major changes in customer orders overall. But crucially, they did mention again the potential risk from tariffs, saying it's something they're watching.
So still an uncertainty hanging out there, even if it's not hitting orders yet. How did the market generally take this report and guidance?
The initial read seems to be better than expected.
Really? Why?
Well, the Q1 EPS and margins were very strong, and the stable Q2 outlook suggests that, at least for now, those tariff worries aren't derailing their business momentum. It kind of acts as a confidence booster, you know?
Like a confirmation that the underlying business is still firing on all cylinders, despite the wider market noise.
Exactly. So it would be surprising to see this give the stock a bit of a short-term lift, reaffirming that fundamental strengths.
Okay, let's broaden the lens again. Looking back historically, say from 2017 up to these 2025 projections, what does the trend in earnings per share tell us?
It tells a story of pretty consistent growth. You see a steady climb in EPS since 2017, but it really takes off after 2020.
Why then? What happened around 2020?
That's when global semiconductor demand just exploded, right? Pandemic shifts, digitization, AI starting to ramp up. TSMC was perfectly positioned to capture that wave.
And how has the market valued that growth, looking at the PE ratio over that time?
The price-to-earnings ratio has definitely moved around. It got quite high in 2021, meaning investors were paying a big premium for those earnings, expecting huge future growth. Then it came down a bit in 2023, suggesting expectations may be moderated slightly.
So where does that leave us for 2025 based on their projected full-year EPS of around NT $55.76?
Well, you could sort of map out potential prices. If the market values TSMC at, say, 20 times earnings, a reasonable PE that implies a stock price around NT $11-15. If you get a higher PE, maybe 25 times, you're looking at closer to NT $30-94. It gives you a framework for thinking about valuation.
And if we go even further back, like look at the EPS trends since the year 2000, what's the big picture?
The really long view just emphasizes how incredibly successful TSMC has been. Sure, there were a couple of years where EPS dipped, like 2001 after the dot-com bust and 2008 during the financial crisis. Market challenges hit everyone.
But overall,
Overall, the trajectory is undeniably up. It shows resilience and an amazing ability to consistently grow earnings over decades by staying at the absolute forefront of technology.
okay, one last piece of recent news. Executive stock purchases in April 2025. This happened after the stock price fell below NT $1,000 in March.
That's right. News came out that the chairman, Mark Liu, increased his holdings by over 400 shares in March.
Was it just him?
No, apparently it was part of a distribution of restricted stock tied to the previous year's performance. In total, 26 senior execs got over 2,200 shares combined. The estimated value is pretty significant, over NT $2 billion at the end of March price.
So top management got more skin in the game.
Pretty much. Even the retiring chief information security officer got some shares. When you see insiders increasing their holdings, especially after a price drop.
It's often seen as a bullish signal, right? A sign of confidence.
Exactly. It suggests they believe in the company's future and maybe think the stock is attractively priced. They're aligning their own finances with the company's success. It's not definitive proof, of course, but it's generally viewed positively by the market.
Okay, so wrapping this all up. It feels like this recent market storm, well, it's definitely stirred things up. There are clear risks, but also maybe opportunities, especially with a giant like TSMC.
I think that's fair. The expert insights we discussed lean towards long-term optimism, even with all the short-term jitters about trade, interest rates, and geopolitics.
And fundamentally, TSMC's own numbers look, frankly, fantastic. Strong profits, strong outlook, massive cash reserves.
Right. The financial health seems incredibly robust. And then you have that potential signal from the insider stock acquisitions adding another layer.
So this deep dive hopefully has given everyone listening a clearer picture by pulling together those different threads, the expert commentary, the economic backdrop, the company financials, the insider moves.
Trying to connect the dots and provide some context for understanding what's happening right now.
Definitely. So here's maybe a final thought to leave everyone with. Given everything we've talked about, TSMC's strong position, its solid financials, but also the undeniable market volatility and those expert views about golden rain opportunities, how do you approach these moments? What are your own strategies for navigating downturns, for spotting what might be a long-term opportunity versus just a falling knife? Maybe take a moment to reflect on your own risk, comfort level, and investment approach in light of all this, something to think about.